This conference will now be recorded.
Hi everyone, it's Patrick Reed from the Adamas Principle. We've got a first. You may have witnessed landings on the moon if you're that age, but this is even better because we've got two experts and one guy trying to ride on the coattails. I'll let you try and work out who. But we've got Adam Gazzoli in the house. Hello, Adam.
Hi, Patrick. It's good. It's an honour to be here with you and Pete.
Fantastic, and it's great to have you. This is a first. We've got three people here on Making Sense of Macro. It's a US special, and there's been a few moves in the markets. What do you reckon?
Hey Patrick, yeah, indeed. I must admit, when I woke up Friday morning, I couldn't quite believe what I was seeing.
What is it with Friday?
What's that?
What is it with Fridays?
Yeah, to be honest, I mean, we're used to the crazy Fridays. It's been a long time coming. I think it was the first time in a long time, actually. And, like I sort of was blogging, I'm not drawing conclusions on a Friday. Some of the moves, I still put a big question mark behind them, but I guess we get through that during our chat in this next hour, I guess.
Yeah, absolutely, and that brings us nicely to what I saw, what I made making sense of it, and I just want to sort of say the moves do not make sense of macro in my eyes anyway. All of the kind of moves were a bit. I'm trying to get my head around them. Really, can't really understand them, but I've got some headlines I've written. Feel free to disagree, both of you. This is just the way I read it. I certainly tell my students to try and do a wrap of what went on. So for me, the big thing for me was a proper risk on with carry EM joining yen pairs getting lifted, and especially on the Friday, we got the dollar off. The dollar index didn't really move. It was softer. Started the week at 97.39. The low of 96.84. However, we closed on a rebound at 97.17. I think that was largely due to the dollar yen component of the dollar index. But all in all, dollar G10 bit softer, dollar yen helping the comeback, and obviously euro was much firmer. It broke that 112.80 that you had been calling around the mid Bollinger Bands for quite some time, B. The important thing for me, and certainly I got this from you, B, was I think it was on the Thursday. I had a bit of fading going on at 112.80 on euro dollar, only because of dollar CNH. It wasn't really moving, but that all changed on Friday because it did come off.
The funny thing on Friday was that leg one was a euro move, right? It was just euro dollar, all the euro cross. Also, was still at the lows. Dollar CNH was still at the highs. So the dollar move was sort of, second leg into broader carry. Actually, it was only on leg two. Leg one, in the first few hours of Friday, you only saw euro go up, euro yen go up, euro sterling, euro Swiss, the whole euro block, which definitely didn't make any sense, when we talk macro, other than that you could argue that positioning is probably quite short euro, and we didn't really get anything from the ECB that would make people, satisfy the shorts probably. Then leg two, I'm not sure where that came from. It was just suddenly, the problem you have, and that's what I'm saying time and time again, which is the risk with euro dollar, because euro dollar is 60% of DXY. If euro dollar, even if it just starts off as a euro cross move, at some point in time, if the euro dollar rally carries on for too much, it's almost self-fulfilling that the dollar has to turn. Like let's say you can get a 30-40 pip move in the euro as a euro cross move, but when it goes 50 or 60 pips, at some point the dollar has a problem. And I think this is probably what happened on Friday. And then just, all lights just went on full green. Stocks rallied strongly. Suddenly everyone felt like, if this is rallying, I want to be part of it. So that's why I say I'm not drawing conclusions on a Friday. To me, it was almost like one thing led to the other, and then the herd was just kind of, it's like the herd's on the trampling. And,
Yeah.
Are there green shoots? Yeah, we talked about them. Is the world out of the woods? Not at all. So it's kind of, we've basically been here many times now where the market just assumes it's going to be all right. And right now it seems that the market is in that mood where they go like, okay, we risk it because if it goes wrong, the central banks will help. It's almost like, and funny enough, and I spoke to the investing channel about it, the IMF revising growth down for the third time in 6 months. They almost rang the bell, which they actually often do. And to be honest, I actually kicked myself for that because I said it to another friend. I said, I wonder if the IMF just rang the bell. And, as traders, we're sometimes a little bit cynical. And actually, they just more or less banked in the low at that point. So, but as we said, for me, the conclusion is Monday, let's say Monday, Tuesday, Wednesday, to see how this continues. And, the euro closed back below 113. Is it a big break? Nah, it's actually not, right? So I'm more the way Aussie moved, and we both talked about this. Aussie had a big job. Aussie has refused in the last few weeks to really break down. And if you remember, the reason I went long Aussie CAD was actually it's my first Aussie long in over a year. And I could only do it against CAD because I'm so bearish CAD. But I already sense that the Aussie is kind of closing the door on the downside. Whether this is less risk off for what it is, I don't know yet. But a confusing picture. Equities at unbelievable level yet again. And I have no answers to that right now, to be honest. I really don't.
You got any thoughts on last week, Adam?
I guess my thoughts are that the G10 currencies did perform better. My feeling is that there's a bit more confidence that a global recession can be avoided. That seems to be growing. There were some good bank results end of last week. JP Morgan and also Wells Fargo. The other thing is, I would say that, I think the US still looks pretty good. I think growth still looks all right there. There is a little risk around the China-US trade talks. But from what I read and from what I see, and I just don't think we're in recession mode, that's all. So I'll just leave it at that at this stage.
Okay, all right, thanks for that. Well, certainly, there's been a bounce on global yields, and there's talk of, especially the 10-year. I mean, I'm looking at 2.6. I'm looking at 2.8. I'm not. They are starting to converge with the equity prices, which is, one's been going south, one's been going north. So very hard to correlate these two. There's lots of they're not straightforward. There's lots of moving parts to any kind of message there. But I know for me, the move on Friday, late Thursday with the euro, and then with the dollar soft and the dollar EM was really hit as well. Carry trade is probably stepping in. Apart from dollar Turkey, that's kind of onto itself. But all the others, dollar rand especially lower. That with everything else, and the yen pairs getting lifted. Rand yen, dollar yen, obviously euro yen and Aussie yen, the star pupils for me. Even our old friend CAD yen, which was interesting. Even that was a bit firmer, and then obviously Euro Swiss higher if you're into that kind of thing. Stocks higher, we're all at kind of frenzied highs on. So I think the difference with look, is it going to be followed through? I don't know, and just like you, B, I do not know. But is this risk on move more credible than previous Fridays or previous sniffs, where it's just been yen pairs getting lifted with equities at their highs? Yes, I think is more to it here. I can't explain it, but I think there's more of a big move here, and it could have been a trigger. You know, and it all kind of fits into place. You, especially with that dollar CNH lower as well, and it all, you know, with the softer dollar and risk on, that makes sense. You know, and bond yields bouncing as well in April, and I just feel there's more to it. But like I say, jury's still out because these moves can reverse quite easily. Let's see what Asia does.
Yeah.
Great. Well, so we've got a US reserve. We've got a dollar special today, and
Yeah.
I'm going to try and pretend I'm an expert now. But I'm going to ask you for your two guys' help.
I put my sleeves up already because I'm very opinionated on this topic.
Brilliant! This is just what we want. Just what we want. So I guess, you know, I get asked, and you see it on LinkedIn, you know, is the dollar reserve currency in danger? B, I think you're perfect to answer
a very strong, resounding no. No, not in a million years. To be honest, this question has come up as long as I'm a trader, and that's now 35 years. There's always time and time again when people talk about it. I mean, okay, we have to talk about two things here. One, there is characteristics for a reserve currency. So let's talk about this. So what do you need? You need a large economy, you know, tick, US. You need a strong army, tick. You need a currency, and that's why the euro can never be a reserve currency. You know, when you have a dollar bill, that dollar bill, no matter how old it is, it's always worth a dollar. If you have euro banknotes, they change them every 10 years. And if you miss the sort of deadline, your €1, your €10 is invalid. A reserve currency cannot have banknotes that kind of get, let's say, they're not worth what it used to be, right? China has no full convertibility, right? So none of them others, then, okay, Europe, you know, do they have a, first of all, we don't have a United States of Europe. We don't have a real Euro army. We don't even have to talk about, you know, I just remember or remind people about this, the war in Yugoslavia where the US actually had to come in because the Europeans could make their mind up. So just forget Europe as a characteristics. China, a long way off. But, and here comes the but, what we do see is obviously that, you know, reserve managers in Asia are obviously, whenever they feel they want to reduce their dollar holdings a bit, they buy a little bit of euro because you only have two solid, deep bond markets. That's the US Treasury market and the European bond market. So if you talk volume, those are the only two that can actually accommodate the large volumes of currency reserves that exist in the world. So what you do see, yes, I think in 2018, I think global central banks have reduced dollar holdings around $160 billion. So that's why I have said to you many times in the past, euro dollar will always undershoot the downside. Why? You have enough of the Asian central banks buying euro. So if you think euro should go to 1, it will go to 105. If you think it should go 105, it goes to 110. There's always plenty of interest of buying going on. We can talk about Iran being sort of blocked out of the dollar, so they're probably gonna, you know, do their oil in euro. The Russians are always mocking about with trying to create something directly with China. We always have these talks, but it's complicated. So to be honest, the day will come where the dollar probably might not be the reserve currency. but it's not for another 20, 30, 40 years. We be retired before that happens. So again, just two most important things. One is what the correct characteristics are. And to be honest, I had 20 years ago, I had a Swiss client, a very wise old man. He had a FX, a currency museum. With a museum, I mean currencies back to 5000 BC, 2000 BC. I mean the full Monty. And he was the one that actually introduced me to, not FX, that was someone else, but through the history of what it needs to be a reserve currency. And as much as people don't like to hear it when we talk armies and when we talk whatever, that's just a fact when you look in history. If you look back in history, it's been those strong nations with strong armies that could protect their outside interests whenever need be. And that's no different now. We can now argue, not that I want to argue about this, but, if you put China versus the US or versus Russia. But, end of the day, as I said, they have a full functioning open capital market, and they tick every box there is to tick that a reserve currency has to tick. So China would never suddenly ditch the dollar. First of all, they would screw themselves, I guess. Nor would the Russians, even if they always do this, blah, 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 blah. They do not suddenly want to have everything in a renminbi. Definitely they don't want to have it in ruble. And I don't think they want to have it in euro either. So I think we're a long way away from that question. Is the dollar sometimes suffering? To be honest, it's a normal cycle. But I don't see even any question about that coming up, really. I just can't see it. That's my 2 cents.
2 questions. They're kind of okay. I'm just going to ask. The first question is: do you think when sterling was the reserve, do you think they were saying the same thing?
To be honest, I'll be very honest with you. I'm not totally on top of my history when it comes to the English or the sort of empire of the United Kingdom, but I would probably think it had a lot to do with the empire at the time. And as I said, my history is a bit weak in that point to actually see, definitely they were probably way ahead of the US given how young the US is, right? So I would think that at the time, without, as I said, you have to fill in some blanks there. But just from my basic knowledge about the empire, I would say probably yes, right? A strong, like big area with a strong army, with a strong, defending interest. So probably yes.
Yeah, probably. I guess my point is when you have a reserve currency, I can't imagine the dollar not being a reserve currency. And I guess if we go back, 70 years, I think it is, or whatever, to sterling, obviously we had a great, great land of seafaring, an army and stuff. But I guess there is that sense that because we've had the dollar as a reserve currency for so long, I can't imagine without it. But maybe that's what they thought when the previous reserve currency was around.
I would agree with one thing. That's a statement I probably made 10, 15, even 20 years ago, that the US, the way we know it, probably has peaked at some point. But, these cycles are going, these cycles going in 50 or 100 years. Those not like, effects when we look 6 months, 12 months, 24 months ahead. These are huge cycles. And the problem is now where the financial system is so complex, you have to really give me an alternative. Yeah, we can argue the euro could be it because he has a, banking system and he has this or that. But Europe has a lot of, flaws in the whole system. You can't, this thing could just fall apart. And I think Brexit as such doesn't help that sort of idea, even though we know the UK is not in the euro. But it just shows that the European Union is not like the United States. Yeah, of course, you can get California that want to separate from the United States. But in theory, you have a group of 27 countries. Not all of them are happy to be in the euro. In 5 years' time, it could lose another 2, 3, 4. Who knows? So it's not like, as long as we don't have the United States of Europe and a true European bond, I think it's hard for the euro to become a reserve currency. You're still going to have Italy. You still, you don't really know what you own, and you can't buy it all in bunds, which actually is what you would have to if you truly want to invest into Europe. Right?
Okay. Yeah. I mean, I guess the second question I have, which is a kind of question I have for myself as well, is that why on earth are we being asked this question when, most seasoned traders and industries and, real money guys just, have to like look at the facts and yeah, like you said, there is no alternative. So why is this question? It keeps coming up. What do you think is the reason behind this?
Either people look for the easy trade. I don't know. As I said, that question comes up time and time again in my entire career, always for a different reason. This time, I think, was it 2 weeks ago when when there was rumor was out that the Saudis are looking to start to move away from the dollar for pricing of oil. Let's just say the US has the Saudis in the pocket. I mean, even if it were that bad, but that was later denied. I'm not sure. I'm not sure, to be honest. If it's jealous, no, I really don't know. I really don't know.
You got any thoughts on that, Adam? You want to chip in? I mean, you don't. What do you reckon?
Well, a bit like Beat, I've been hearing this topic for a long time, and it's a bit similar to, will the centre of foreign exchange move to Paris or Frankfurt? And I still don't see that happening, even though we're in the midst of Brexit. But I think Beat's 100% right. These other countries, such as Europe or China, even, they don't have the history of monetary discipline, open markets, and consistent and transparent governance. To have a reserve currency. So I think there are some of the things as well that are required. I mean, definitely de-dollarization or diversification. I see that happening and continuing.
Yeah.
The Russian central bank has been quite public. They've been diversifying away from the dollar into the renminbi. As well, a lot of the international trade is in US dollars still, although 10% of international trade is from the US. So, and the US is the center of capital markets. So I think it'll be a long time, a very slow transition before we see anything sort of concrete on that level.
Sorry, go ahead.
No, I was just saying that, that's my 2 cents there.
Adam, feel free to make a case for the Australian dollar to take over.
The Russians have been known to be buying that. And as Beat said earlier, I sense we might be at a bit of a bottom there in the Aussie. So, looking at ways to get long there.
Good stuff, mate. Good stuff. I did a little kind of fact find, really, and I'm not sure some of the websites are spurious, but anyway, I'm going to throw it out there. Some of the obviously, as a reserve currency, you get privileges, and one of those privileges is, I forget the actual name of the term, but every dollar you print, you make money off. For the actual cost of the paper, you can sell that dollar. That's what I read. I think it was from a guy, ex-Medley guy. So that was quite interesting. The other thing is the US has to provide a certain amount of dollars to fund certain things. It's not a typical funding currency as such, because obviously it's not a negative yield. It's not like the yen, but it does fund EM deficits. So when there is QT and interest rate hikes, EM, you could see a lot of pain there. And the other thing is, because the US has a certain amount of dollars offshore, it has to, it has to provide that liquidity globally. The import and exports are a lot easier. So it has, in some ways, also additionally, cheaper credit, or a potential of cheaper credit. So it does come with privileges, but it does come with responsibilities. That means,
yeah, you see that the responsibility that the Federal Reserve is actually, when the shit hits the fan, are actually doing policy for the world, right?
Yeah.
And like when you wrote my piece from my feedback that I made, a meeting that I had with my friend, he's of the strong belief that the January meeting for the Fed was for the US and for the Fed, and the March Fed meeting was for the world, right? With the ECB a little bit the back to the wall, with some emerging markets with the back to the wall, and the Fed just go like, okay, this was maybe, and I was blogging about it, and it annoys me, this discussion, even the Draghi article over the weekend talking about Fed independence. Really annoys me, because I really strongly believe, I mean, I don't know JP, nor do I know Trump and whatever, but I think it's a pure coincidence of, and we talked on one of our last Make Sense of Macro about it. If you have such a strong deceleration in the German economy, you have like weak data across the world, and you just hike 9 times. I mean, it's a no-brainer. We could be Fed chair and go like, you know what, probably the best is if we go to a pause. So this sort of, the Fed responding to the pressure of Trump is just completely ludicrous. And so what the Fed is doing, and has done so time and time again, I remember about Bernanke. Bernanke was just about to taper when he held off. And we had like this big sort of turn. Then Yellen was very dovish and realizing that the pain out there is still too great. So the Federal Reserve, and you rightly say, it comes with responsibility, and they have taken care of that time and time again. And like I said to you before, if this all would head to a recession territory, with the ECB very thin on bullets, or so to speak, none, who is going to bail out the ECB, or who is going to bail out the market? It has to be the Fed, because it's the only one that actually has done something of a normalization in terms of policy. So it'd be the Fed. The Fed came to rescue of the world time and time again in the last 20, 30 years, right? And that's why they do take responsibility. They could have killed a number of emerging markets in the last, God knows how many years. And they always backed off just when things became a little bit too tricky, right? And so I think they've done that. People may or may not give them credit for, but they've done that.
Great, thanks. Just what we need, really. So do you think, both of you, do you think the US has acted responsibly, or has it been a bit kind of, with its own kind of spending, has it been a bit kind of relaxed as a reserve currency?
To be honest, the only thing I would say, look at the US economy versus the European economy, and you tell me, at least at that point in 2008, 2009, what was the better plan? Just kind of spend and worry later, or do what the Europeans done and gone on hitting the brakes, right?
Yeah.
I mean, it's the timing of this whole, cut spending was just the worst possible time. You know what? That's what frustrated Draghi, right? Draghi has addressed the European leaders time and time again to ask for help, but the ECB can't do it all, and they didn't help, right? Next time they have to, because the ECB has no bullets, right? So I think, well, we can close the circle and say you can do that if the dollar is the reserve currency, right? You can do it easier than, because you have plenty of people buying your debt. If you're not a reserve currency, it's a little bit harder to do what they did, right? But I'm not a fiscal expert, to be honest. And at one point in time, the US is going to pay the price. I don't know. As long as people are willing to buy treasuries, maybe they can kick that can time and time again.
That's fantastic. I think that pretty much clears that one up. You got anything to add, Azam? I want to chip in.
No, I think Pete summed it up nicely there.
That's great. So that's it on the US dollar special. So let's talk about next week, a bit on the markets, and what our thoughts are. I've got my charts up. I've got euro dollar. I'm just going to go through it. Just let me know. I mean, 112.80 here is. Can you both see it there?
Yeah.
Okay.
Yeah, thanks.
I mean, I'm looking at, obviously this is a big level. I'm looking for this to hold. If it does, you can probably see a little bit more upside. But euro yen was just the big mover for me. If that goes there, look at that. Very nice move. And obviously Aussie yen was a big move as well. All of this is all helpful in a little bit way on euro dollar. But where do you see euro dollar, Beat? Do you think we've chopped out here, or do you think it's got a bit more legs?
To be honest, I really keep it simple. While we stay above 112.80, it has room to 114. I just see no fundamental reason to owe euro, especially ahead of the May European election. Well, even so, I don't, to me, the dollar is by distance the best of the rest. And what I think has happened is like what we said. We hit the big 111.75.80 again. We couldn't break. The market, if I read correctly, I think the IMM shorts have been the biggest since at some point in 2016. It's really, it's basic foreign exchange. What cannot go down has to go up. And I think this is one thing that has happened. The people may have expected too much from the ECB. We both talked about it, that you can't expect much, that they're going to buy some time. So maybe the whole, throw everything in there, a little bit of okay Chinese data that we had from export, the trade data in China, the credit data in China. So suddenly, the shorts just saw like, there's no way out. And so a squeeze to 114, we can't rule out. If you break 112.80 very quickly again, let's say Monday, then maybe the whole thing has already topped. But I stick to the view I think I said 1 month ago and 2 months ago and 3 months ago. And I know it's boring, but there's no divergence between the ECB and the Fed. There's no divergence going to open anytime soon. So the euro is going to remain in the 2-3 big figure range for another few months. It's just, I think we talked about it last week. The reason FX is so dull is really everyone went dovish at the same time. Now we have better data, we get a bit of risk on, but generally there's just no divergence anyway. We have central banks globally gone dovish or on hold, and we know we need divergences. We need like one country going, hawkish and one goes dovish. There is your easy trade, and now we just had the Fed go on pause, the same time the ECB goes dovish. There's just nothing happening. The only time I can see something happening is if the euro data would suddenly miraculously turn around to the top side, which I doubt, or suddenly we talk about one last Fed hike in late 2019 if the data remains strong. Then you suddenly have either another Fed hike to deal with, or the first ECB hike is going to come. But from what I heard from sources is that Draghi wished to kick the first hike into June of next year. The compromise was end of 2019, but there was never reading the German papers, they really remain very bare. So that the recovery in the German economy, they cannot see starting before second half of 2019. So in a data sense, it's very hard to see a big recovery coming. So, or you believe that the US data suddenly crater. If you're worried about the US data, and then suddenly the markets truly start to price in cuts, yeah, then we have a little bit more room on the top side. But as things stand, if we talk about next week, I think, we're going to be 112.80, 113, whatever, 30. Then we maybe go up to 50. I don't think it's a powerful follow-through move. I don't think so.
Yeah, I mean, on the China thing, there's some talk going around. Some guy from BNP posted on my. I was asking something about money markets, and he was looking at another triple R cut next week. That's what he expects. Also, green shoots. I mean, I'm not convinced of green shoots, but the market is,
Yeah.
and a trade deal, the market's convinced, and that could be enough to actually give Eurodollar another lift higher if dollar CNH goes much lower.
By the way, we have on Wednesday night, we have Chinese GDP, we have Chinese IP, we have Chinese retail sales. So we have quite a bit of data next week. We're kicking off on, actually we have a lot. We have German ZEW on Tuesday. We have PMI. We have US retail sales as well. Yeah, we have. So we have quite a lot of data out next week. So it's going to be very interesting. And the one thing that my Asia source said that the next PMIs in China are going to be weaker, but not as weak. So bottomed out, but those who look for progress just straight up is not going to happen. And the other thing he said is China will not repeat 2016. China will not open the floodgates. China is unwilling to throw the kitchen sink at it, and China will not flood the market. And they continue with this kind of, trying to get rid of the shadow banking. So this whole deleveraging will continue. So I think, and that is my frustration, or let's say how hard it is in the short term to trade, because the market has that belief, and as we both know, we respect the market. But the market is getting ahead of itself. China's turnaround, the way they plot it, is a very slow, gradual move back up. Yes, we're not going to have a hard landing, so we don't have to worry about the total disaster. But I think the market thinks everything is just going to go like V-shaped recovery. No, it's not going to be a V-shape. It's more like a U-shaped recovery. And so there, I think, is where the market gets it wrong. But in the short term, we just play along, try to sniff it out when the data starts to suddenly, weaken in terms of giving some stuff back. And that's when the market is suddenly waking up. But, I think hit and run approach right now is probably the more clever thing to do than big views. I think the market, to be honest, as bullish as risk was on Friday, it could be as bearish on Monday. That's how I think the market has very little conviction. And as soon as something turns, the market will turn. But I agree with you, it feels a little bit different. It feels it gets a little bit of legs at the moment. So I'm not going to be in a hurry to sell risk right now.
Yeah, well, that's the thing, exactly. And it's not just about buying what the market you think is doing. It's about not buying if you're the opposing view, and if you're a risk bear, just not to do that. I've got the DXY up here. This is how rubbish it is. This is the weekly. That 97.70 is the top of the Bollinger Band. It's also a nice level. This is, look at that. It's just absolute rubbish.
Yeah.
Total rubbish.
Yes, in ages, really, right?
Yeah. Absolute rubbish. So we feel that there's probably a cheeky long somewhere for me around 112.80. Let's see what happens in Asia and London. But if you had a gun to my head, I would actually, just because of the the stars aligning with yen, EM dollar off, CNH higher, you know, euro dollar, euro yen, Aussie yen, all of the stocks, bonds, yield bouncing. I just think it has probably a more risk on. That's just my gut feeling on Monday. But let's see. I mean, you know, anything can happen, especially with this market. How are your view? What's your view on risk, Adam? Do you sort of how's your feeling? How's your gut?
For me, next week, you know, my sense is trading will be light. You know, you've got a lot of holidays coming up. The US, Canada, the UK, several European and Asian markets will be closed at the end of next week. So, and also with Europe closed the following Monday. So, you know, slightly cautious. Just to note, there will be some US corporate earnings coming out this week.
Oh yeah, that's right.
Keep an eye on that. I think, you know, I agree with Beat. You know, 1280 is pivotal. You know, is a pivot for me this week. I think keep an eye on Libya. There's some issues over there, things brewing that could affect supplies in oil. So that's just something to bear in mind. You know, I think for me, risk. I mean, I really don't have a strong view, actually. You know, but one thing I noticed, we haven't spoken about the great British peso.
Oh, dear.
What's that? Is that a currency? I know it used to be popular like one time, didn't it? Right, let's get it up. Right, I don't touch this apart from the lower Bollinger Bands. See, well, I've got Beat to blame on this because he got me on Bollinger Bands, right? So Beat, I've been trading this. I bought it there, I bought it there, and I bought it there.
Not so bad, is it?
Not so bad, mate. And look at that, he did it there as well. I didn't buy that one, but
not so bad.
Looking good, man. Looking good. But you know, anything with Brexit is very difficult. But B, I know you're across that. You give some great commentary on Brexit. But you know, I think there's been so many twists and turns and so many pantomime vaudeville villains, but no heroes. B, over to you. So talk about Brexit.
Yeah, to be honest, it's been interesting to see that for the first time, the kicking the can hasn't actually led to a rally in sterling. Every time before, in early in 2019, every time we kick the can, sterling managed a rally, and everyone goes like, yeah, whatever. I think this time people start to realize that actually there are new risks coming up. The new risk being general election. That didn't bother the market until recently, because up to about 4 weeks ago, the Tories were in the lead despite really all the fumbling around Brexit, or the terrible job they've been doing. So suddenly we have a big drop on the Tories. The talk is they lose as much as 60 seats if there were any election. You suddenly talk about a Corbyn government. You talk potentially about a Corbyn coalition government, because he might not actually win outright. And that's just lights out for Britain. So suddenly you have a risk that is genuine. You know, the Tory party just read itself to pieces. What the New Deal, there was something in the weekend press talking about that the 1922 committee could actually change the law, that they could actually challenge Theresa May again. You know, when you have the no confidence vote, you're not allowed to bring it back for a year. So somehow some people find like a clue, or like a whatever, a little opening that actually could change something, so you could bring it back and actually challenge Mrs. May. To be honest, I'm glad that we have about 11 days of a break about talking about Brexit, as Theresa May sent everyone on vacation to come back refreshed. There will be the fraction that will try to push a deal through until 22nd of May, because that is still the deadline where we would not have to hold European election. Once we pass 22nd of May without a deal, that means that UK has to participate in the EU election. And that's just outright embarrassment for the Tory party. I mean, it's just, you know. So I think the market is doing the right thing right now. I think it's kind of, you know, because a decision one way or another is so close, even though, I mean, yes, I know the new deadline is October, but people feel that the real things are happening in the next 1 or 2 months. So there's almost no point, you know, investors were forced into sterling from, you know, the big move up we had, because obviously suddenly everything looked like less hard Brexit, more soft Brexit, more whatever. So people were very underweight sterling, so they had to obviously catch up a little bit with their position. Now I think we're in a balanced market that kind of just goes like, you know what, there's no point me being short, there's no point me being long to preempt what the political development will be. So I would not be surprised if sterling hangs around in a very narrow range, as it's done recently, because no one has a wish to actually be long or short. Only when we get the next real batch of news that is either really get rid of Theresa May and we get Boris in, or there is a risk of general election. The moment you hear general election, you just close your eyes and sell the pound. I mean, just sell it, you know, because the risk of a Corbyn government is real now. You know, it hasn't been real 4 weeks ago. It's very real now. And you know what? I might actually just, you know, move to Spain or something if that happens. I don't think I want to be part of you know, I want to be sitting here with a Corbyn government. Oh, it'd be a disaster. You know, it really be, you know, like, I'm not even, you know, it's not even anything to do with whether I like the guy or not. That's not the point. The point is you just read his views, his manifesto, and you just start to worry, you know. That's actually the bigger damage to the UK than even a hard Brexit could do. Hard Brexit, yes, things going to be bad for a few years, but then, you know, things going to sort themselves out. A Corbyn government, that's when the real trouble starts. So that is my bigger worry at this point. Right now, sterling, like I said to you before, I haven't traded sterling in 2019. I continue not to trade sterling because I have no angle. I have no, you know, I can't risk manage it because I actually don't know. You know, it's just changing too quickly, and there's no, you know, I like to have an angle at things when I really feel like, you know, things going one way or the other. With UK politics right now, it just flip flops. You just don't know. It's too risky, especially if you trade money as well. You just, you know, I'm not prepared to take a 50-50 risk. It's just not my style.
Yeah.
But I'm clear. You know, I think there's, you know, the next many weeks, we will not know anything about where we're going.
Well, that's brilliant, Pete, as always. You know, I completely agree. I've just been, as you were talking, I've just been popping up the weekly. You know, this is a weekly, and I mean, that's how hard it is. You know, if you look at the last 1, 2, 3, 4, 5, 6, 7 weeks, we've been kind of opening and closing, and it's been quite choppy. We're slightly nudging lower there. But look at the range. I mean, there's just really, they're not completely backs up what you're saying. You know, the big players are not around, and let's just wait and see what the week gives us. So just a few more charts. As I said before, this is Euro Yen, very nice. We're nestling around the top of the upper Bollinger Band, which is 126.76. That's the top round there.
We selling at 127, Patrick?
Possibly. You know what? Hunch. I'd I fancied buying Eurodollar at 112.80 into it. That's just me, but just because of the CNH move, I don't know. Let's just see if this does.
If you manage dollar, if you mention dollar CNH, we still a big figure above our key level in dollar CNH, the 669.50, right? So as long as dollar CNH doesn't break that or closes below that, I think this dollar move is just running on fumes.
Okay.
You know, when I see the break of, you remember, right? We look at that level for what, 4 months now.
Yeah.
As long as we're not close below there, I think the dollar will not put in a big move. I just can't see it.
Yeah, that's right. This is the one, isn't it?
Yeah.
Down there.
Yep.
Okay. All right. That's interesting. Yeah. Well, I guess how much upside would that relate to Eurodollar? But or you know, with Eurodollar, I call me old fashioned. I quite like this is work to me. Let's have a look here. Here we go. This is work.
Right. You buy 112.80 to make 50, 70 points. Yeah,
that's it.
If you think we are ahead of a Euro bull market, then I think we have to rethink. So that's why I say charge. Yeah, you know what? No problem with it. You buy against 80. If it goes 65 off, or you sell it, you know, it's nothing lost, right? But I just think you don't get more than 114. But in this market, if you can make a big figure, why not, right?
Yeah, I mean, happy days.
Happy days, absolutely.
Yeah, I like that 114 up there. That's lovely up there. So there's the dollar yen. That was another star pupil. We're up here. Let's have a look. I'm offered around 112.20. So yeah. that's me on that one. And I think this was a risk on move, and then obviously dollar was soft helping this as well. So but I still fancy that a little sell up there. What about you, B? Do you like it up there?
Sorry, what's that?
Any thoughts on dollar yen?
Yeah, to be honest, it's the same. It's a no, it's a cheap no-brainer fade. You know, risk 20 pips, see how it goes. Fade 112.20. For me, it has always been the case this year. If you break 12.20, you know, just step aside. Could go all the way to 114. You know, and whether it makes sense or not, I don't even ask myself. I just, you know, will fade at 112.20, 25 pips, stop, walk away.
Yeah.
Either the dollar down broadens or risk tops out, or we just get 1 or 2 months risk on rally, like we discussed what actually the risk would be, and then we blow up in summer like we always do. So then we just delay the blow up a little bit.
Yeah. Any thoughts on dollar yen, Adam?
Well, I think an impressive move last week, and you know, that was the one that got away from me because you mentioned that 110.65, 110.70 level, Patrick, and I'm kicking myself. I didn't buy it, but yeah, I'll be up there selling towards 112.20 this week.
Good stuff. Okay, and then our old friend, obviously, Aussie yen helping Aussie dollar, all getting nice and it's not straightforward. Let's just have a look. Here we go. Yeah, this is trying its best. I mean, I like this holding here, and this is quite compressed vol. You know, the Bollinger Band squeezing, begging for a break really, and let's just properly breaks above this. If it closes above, it'd be nice for it to close above 72. But go on.
Oh, just one thing to note. You know, sometimes the sterling and Aussie move together. There's a correlation there. I know you've got all those Brexit headlines, and But you know, if Aussie continues higher, and you might see sterling follow suit a little bit, or cable. It's something to keep an eye on.
That's really good. Thanks, Adam. Interestingly, there's that 73.10, 73.30 level, which is massive on the weekly.
Yeah,
I know
a big level on the way down as well.
You
massive
like
on the way
one. What's that?
It was massive on the way down. That was my mother of all levels in every bounce. Back in, when was it? Yeah, I think on the way down it was huge, and it tested it on the way back up once again and failed. So that would be a big pivot. So break above 73.30, and I would probably completely forget being bearish also.
Yeah. Yeah.
And hopefully by then Aussie Canada is a lot higher.
Yay! Thanks, mate.
Cheeky one.
That's right. Yeah, it's good stuff. So we're going to finish today. Thanks both of you for the show. It's just been fantastic, and just finish you with Dow Jones. I think this looks like it wants to top out. If we close below 27.8, we could get a confirmation of that, but we're not there yet. And S&P looks like it's thrashing at the highs to me, which could be more upside, could be breaking up. It's knocking on that door around this level. So Pete, you got me onto, with risk pairs, you got me onto stocks quite heavily. So what are your thoughts on really quickly in relation to with risk? What do you reckon on the Dow and S&P?
I mean, to be honest, I think Adam mentioned something important, and I was reading that in the FT last week, that apparently the earnings season, we expect the first negative earnings seasons for the S&P since 2016. So JP Morgan was a bit different. Maybe the financials are not the ones to actually watch. Probably we have to watch the real economy, where we apparently start to get a lot of downside surprises on earnings. So, I'm not, usually I kind of know when the big ones are out. I do some intelligence gathering early in the week to see when the sort of heavyweights are coming, the non-bank stuff. Because the bank stuff, to be honest, US banks should make a lot of money with 9 Fed hikes, right? So if they have a curve, right? In Europe, we don't have one. The US banks, actually, if they're not making any money now in fixed income, then it'd be a real troubling time. So the banking sector, I'm not really looking at right now. I want to see the earnings from the real economy. And there, I think the signs are not as bullish as maybe what we get from the banks. And that will be the first real test of the US equity market. Right now, I think we just, it's the way the Fed has changed, obviously to give the market again that sort of hope, it's going to be all right. It almost looks like we sort of kicked that can as well down the road, where people just not worried to buy at these levels. I think it's ludicrous, but especially where the global economy is and where the US data could head to. But what do you want to do? I've been negative stocks for a while, so I should maybe just shut up and not even talk about it. But you see the chart yourself. How likely is it gonna be that we're gonna have another massive bull run at these levels with actually peaking economy activity and with corporates that are actually starting to do less good? There's another article again over the weekend talking again about the buybacks. The buybacks are the single only reason for equities to be where they are, right? If you take them out, stocks will be complete somewhere else. So now we can argue, okay, buybacks are here, so it continues. Yeah, maybe. But this is a market that has completely lost its anchor. It lost its anchor because of QE from the Fed, global QE, buybacks. Personally, I don't even think we can really know where stocks really should be if a few of these things change. So, am I going to be short? Maybe not. I definitely not going to buy. I started actually for my personal sort of pension stuff. I started to cut out of all equities. As a risk bear, maybe that's and if it rallies more, okay, whatever. But I just think, I just don't see things adding up. I think the market in equities has ignored negative news time and time again this year. I'm not saying they should have created, but they haven't even reacted to negative news. And I think there's just this dislocation between, central banks going to sort it out. And, let's not forget, the Fed, part of the Fed hikes has been to bring the stock market lower, right? There is a bubble in there. And I think at these levels, I think the Fed would not have minded to have stocks grinding lower and be a few thousand points lower. No, not let's say collapsing, but I think it will be a problem for the future for the Fed to have stocks at these high levels and not having adjusted to the real the real data and to 9 interest rate hikes. I think it will be a problem in the future. But right now, to be honest, let the market speak. I think I did not expect the S&P to see 2,900 again. Here we are. And I'll be just Googling on my chart to see when it actually starts turning. So I don't know. To be honest, Patrick, we talked about it before. I don't understand the dynamic anymore in equities. And to take lower yields, or now you see like 10-year treasury is 256 again, right? So at 240 we go like, oh yeah, it's good for stock. Now as the yields start to recover, it doesn't matter, right? Stock still beats. So I don't get it. The mechanic I don't get right now.
Yeah, I mean, you could say that higher yields is good for growth, but it's not straightforward correlation because the
problem is at the moment it seems everything is good for stocks. Weak data, strong data, higher
exactly.
yields, lower yields,
exactly.
trade deal,
So
no trade deal.
Well, you said it in one, and I want to sort of, my thoughts are this: if you do the splits on value and growth for winning. So this, to me, this equity, and what happened to the embargo? We're in the midst of April. It hasn't affected it at all on the buybacks, right? And also, you've just got this looks like a momentum move, and it brings back. It looks like it's bubbly. The vol's not there. There's fewer participants, and it just looks like it could go on. These things do go on. Insane buying, because all of this stuff that we spoke about with embargoes and the macros not fitting it, all should be, all of the Germany thing. It just the general global slowdown narratives and overlooked.
Yeah.
Any small thing of good news bought up, snapped up, and the rest of the currencies, the rest of the markets enjoying this as well. So it's all on the same page of risk on. So I just feel this could go a lot long. This could go a lot higher.
Yeah.
Dangerously higher.
Ooh.
What do you reckon, Adam? Finally, you say the final word now. I'll have nothing else.
Well, I think I learnt this, or I heard this in about 1980 something. But don't stand in front of a fast train.
Freight train.
Yeah. Brilliant. Well, thanks very much, guys. I appreciate you taking the time out. It's really, it's a privilege for me to speak to both of you. Before we go, I just want to tell you about Beats and Mason commentary. It's he works incredibly hard, and he just gives lots of insight and through his wealth of over 35 years, and I'm constantly learning from it. I know he does post on LinkedIn, but it's just a small fraction of what he gives. So, Beat, would you like to tell us a bit more?
Yeah, thanks very much, Patrick. Yeah, so what I do is I just put like from all the, E10 dollars, G10 crosses, emerging markets. I make my 4-hourly daily charts. What's on there is on the 4-hourly charts, traders, day traders have their sort of key levels. There's always a narrative there, the story, the theme, my risk, what I'm doing. And then as well, I send out sort of live commentary in terms of market news, how I read it. So I think for the professional, it's probably interesting just to see my take. For the retail traders, it's probably just interesting to actually see what you have to watch, what we make of it. The whole, it's almost tutorial, I would say. And then obviously I read my 2 cents piece, which I sometimes just sort of go on to 30,000 feet just to sort of see what I think about the world. And, all now and then I kind of puzzle things together correctly and are maybe a step or two ahead of the market. So whoever is interested to see what my, the full, you mentioned it, Patrick, obviously I can only show a small amount of what I do on LinkedIn and Twitter, but whoever's interested to know more, ping me directly or Patrick and we can have a chat about it. Thanks very much, Patrick.
That's great. Well, the show's over now. It's been an absolute pleasure. Adam, thanks very much for coming in. And this is, I hope you're going to join us again sometime. And it's just been great to have you on.
No, definitely, Patrick. Thank you for inviting me. And I look forward to coming on again. And great to, be here with Pete as well. And good luck to the both of you this week. And
Thanks
to everyone.
Thanks very much.
Okay.
Thanks again, Pete. Thanks, guys.
Thanks for having me. Good night, everyone.